Right now, the AI market is going through a massive expansion phase. Billions of dollars are flowing into data centers, automation systems, and enterprise AI infrastructure. Most of that capital is going into the same large-cap names everyone already knows. But here's the catch. While attention is locked onto those major players, there's a different layer of smaller companies operating underneath. Companies tied to the same ecosystem, but trading under $2. In this video, we're looking at two of them, one trading around 0.89, the other near 142. Both connected to growing technology-driven markets, but neither has seen the attention you'd normally expect. So the real question becomes, why hasn't the market fully reacted yet, and what happens if it does? Now this is where things get interesting. The AI narrative is heavily concentrated in obvious areas: chips, GPUs, cloud infrastructure. But underneath that, there's a quieter layer forming. This is where pricing inefficiencies usually exist. This is the type of layer institutions quietly watch, not because it's obvious, but because it's overlooked. We're talking about data systems, infrastructure optimization, and real-world deployment layers. These don't always move first, but often move later. Now, this doesn't guarantee anything, but it explains why this area matters. Historically, when attention eventually shifts, it tends to move fast. This is exactly where smaller cap opportunities tend to form. So let's start with the first stock. This company operates in a part of the AI ecosystem that's becoming increasingly important. But it is still largely ignored. It's not building AI models, it's not designing chips. Instead, it focuses on something more fundamental: data. But not just collecting data, organizing it, structuring it, and making it usable in real-world systems. And this is the part most people miss, because AI is only as powerful as the data it can access. If the data isn't usable, the system doesn't scale. Now, this company is building a platform designed to connect and streamline large volumes of data, particularly in complex environments where information is fragmented. But here's the catch. Most investors still underestimate how difficult that problem actually is, because in industries like healthcare, data isn't just large. It's disconnected, inconsistent, and often unusable in its raw form. And if this layer expands, companies solving that problem become critical. Because as AI adoption increases, the need for structured, accessible data becomes even more important. Now, when you zoom out and look at where this fits, it's not the flashy front end. It's the foundation, the layer that sits underneath everything else. And historically, foundational layers don't always get immediate attention. But when they do, they tend to reprice quickly. Now let's talk about movement. This stock has traded at higher levels in the past, before pulling back significantly and stabilizing around the 0.89 range. So what you're seeing is a reset, from higher expectations to a quieter phase where attention has dropped. And now the question becomes, is this stabilization or just a pause before the next move? Because in emerging sectors, price movement rarely happens in a straight line. It builds, pulls back, and then reevaluates. From a business standpoint, the company focuses on enabling access to large-scale data sets, particularly in sectors where data fragmentation is a major challenge. It's not a hype-driven model, it's a utility-driven one. And when you actually look at the company behind this is where things shift. It's OneMedNet Corp, trading under the ticker ONMD, currently around $0.89. Now, this doesn't mean it moves tomorrow. There are risks here. Timing is the key factor. But it does explain why it sits inside a segment of the market that hasn't been fully priced in yet. Now, before we get into the second stock, here's something most people completely overlook. Even though AI demand is exploding across industries, not every company connected to that trend moves at the same time. Some react immediately, others lag behind, sometimes significantly. And those delays are often where the biggest pricing gaps exist. So now, let's look at the second stock. But unlike the first company, which focuses on organizing and enabling data, this one operates on a completely different layer. Where the first deals with data structure, this one deals with data efficiency. And this is where it gets interesting, because instead of focusing on collecting or organizing information, this company is focused on reducing how much data is needed in the first place, specifically through advanced video compression and optimization technology. Now that might sound simple, but in a world where AI systems rely heavily on video, imaging, and real-time processing, bandwidth becomes a bottleneck, and this is the part most people miss. As AI scales, data volume doesn't just increase, it explodes, and if infrastructure can't handle that volume efficiently, performance slows down, costs rise, and scalability becomes a problem. Now, if AI adoption continues at this pace, companies that can reduce data load without sacrificing quality become increasingly valuable, because they don't just improve performance, they make scaling possible. Now, from an industry perspective, this sits right in the middle of AI infrastructure expansion, especially in areas like video streaming, surveillance systems, and cloud-based processing. But here's the catch. It's not a headline sector, which means it often flies under the radar. Now let's talk about movement. This stock has also seen higher price levels in the past, followed by a pullback and stabilization around the 142 range. So again, you're looking at a reset phase, from prior momentum to current consolidation. And now, the question becomes, if demand for data efficiency increases, does attention follow? Because historically, infrastructure enablers tend to move after the demand becomes undeniable. This is where it gets interesting, because when you actually look at the company behind this, it's Beamer Imaging Ltd., trading under the ticker BMR, currently around 142. And just like the first stock, this doesn't guarantee anything. There are real risks here, but the positioning is what makes it worth watching. So now you've got two very different setups, one focused on enabling and structuring data, the other focused on optimizing and reducing it. One operates at the input layer, the other at the efficiency layer. And this creates a very interesting comparison, because the first stock may benefit as data usage expands and systems require better organization, while the second may benefit as that same data becomes too large to manage efficiently. So the real question becomes, which one gets recognized faster? The company helping AI access data, or the company helping AI handle it? And more importantly, which one is the market currently underestimating more? Because that's usually where the opportunity is. Now, when you zoom out, the bigger idea here isn't just these two stocks, it's the layer of the AI economy they represent. Because while most attention stays focused on the obvious leaders, the supporting systems underneath, data access, optimization, and infrastructure efficiency continue to expand. And this is the layer that tends to move later, but often more aggressively. Not because it's guaranteed, but because it starts from a place of lower expectations. If this gave you a different way to look at the AI market, that's the goal. And if you want more breakdowns like this, you already know what to do.